Hello everyone, respected chairperson, distinguished researcher, academician, and fellow delegates. I'm Dr. Charusheela Shah from Thakur Institute of Management Studies and Research, Mumbai, India. Today, I am pleased to present my research paper titled Overall CAMEL Ratings and Financial Health Comparison of HDFC Bank and HDFC Ltd pre and post merger. The study examines whether the merger has strengthened the financial health and strategic position of the combined institution using CAMEL framework. Let's begin with the context of the study. The financial industry is undergoing significant consolidation driven by the need for scale, efficiency, digital transformation, risk management, and strong customer. The HDFC Bank and HDFC Ltd merged completely on 1st July 2023, which is particularly significant because it brought together a leading private sector bank and one of the largest housing financial institutions. The strategic rationale was to combine HDFC Bank and HDFC Housing financial and funding capabilities. Therefore, the key strategies and research question is not simply whether the merger increases the size, but whether this increased scale translated into a better financial efficiency, profitability, and liquidity. The presentation identifies the merger's date, scale, strategic rationale on this side. Research objective and methodology. This study has 4 broader objectives. First, evaluate financial health of the institution across the CAMEL dimension. Second, to compare important financial ratios between pre and post merger period. The third, to examine the implications for operating efficiency and profitability risk. And finally, identifying strategic strength and potential risk arising from the merger. The methodology used in this study is descriptive and analytical, which is based on secondary data. The analysis uses annual reports, company disclosure, RBI related information, and investors' presentation. The primary indicator includes capital adequacy ratio, GNPA, NNPA, cost to income ratio, NIM, ROA, ROE, CASA, and LCR. The important limitations is that the post-merger represents an early stage of integration. Therefore, some of the observed changes should be interpreted as transnational rather than permanent structural outcomes. CAMEL framework. The analytical foundation of the study is CAMEL framework. CAMEL evaluates financial institutions through 5 dimensions. C stands for capital adequacy. C stands for capital adequacy. E stands for asset quality. M stands for management efficiency. And E stands for earning. And the last L stands for liquidity. C stands for capital adequacy, which assesses the institutional ability to absorb financial shocks. Asset quality particularly focuses on the level of non-performing assets, whereas management efficiency examines productivity and cost efficiency. Earnings, which includes NIM, ROA, and ROE. And the last but not the least, liquidity assesses the institutional ability to meet its financial obligation. An important feature of the framework is that the preferred direction differs across syndicators. So, for example, higher capital adequacy and liquidity are generally desirable, whereas lower GNPA and NNPA are desirable. This proves a structural biases for comparison health, financial health before and after the merger. The next, capital adequacy and asset quality analysis. Now let's look at the first two dimension of CAMEL analysis, which is capital adequacy and asset quality. The pre-merger CAR of HDFC Bank was approximately 19.5%, while HDFC Ltd reported approximately 23.7%. The project post-merger CAR is approximately 21.6%, with Tier 1 capital around 20.5%. This indicates that the combined institution has a stronger capital position and is well placed to support its expanded balance sheet. However, when we move to asset quality, we observe a slight deterioration. HDFC Bank pre-merger GNPA was approximately 1.34%, while the post-merger figure is estimated around 1.2% in the presentation, with NNPA around 0.36%. The important point here is that the study does not interpret this movement as a major deterioration. Rather, it is suggested that some asset quality blending is associated with the integration of HDFC Limited loan portfolio. Therefore, the key message from these two dimensions is capital strength remains robust, while asset quality integrates need continuous monitoring. The next two dimensions provide particularly interesting insights about cost to income ratio, which is expected to improve from approximately 40.2% to 35%. If achieved, this would indicate significantly efficiency gain from integration. However, the earnings indicate shows a more mixed short-term picture. NIM declines from approximately 3.13% to 2.90%, while ROA moves from around 1.82% to 1.70%. ROE was shown as a short-term decline for approximately 15% to 14%. At first glance, this movement could appear negative. However, the study interprets them in context of portfolio blending and merger integration. The important research implication is that merger performance should not necessarily be evaluated only through immediate post-merger ratio. There may be a transaction cost in short term, followed by efficiency and revenue synergy over a long-term period. Thus, the study identifies a potential trade-off between short-term profitability pressure and long-term synergy rationalization. The next, liquidity position and funding structure. Moving to the last dimension of CAMEL, which is liquidity, the picture is relatively resilient. The CASA ratio moves from approximately 48% to 44.5%, reflecting the blending of the two institutional funding structure. The loan to deposit ratio increases from approximately 85 to 90% to 96%. At the same time, the liquidity ratio coverage ratio is approximately 115%. This provides an important buffer during the integration phase. The study therefore considered the liquidity position satisfactory, supported by a diversified funding base and particularly mortgage-related assets. Therefore, despite some changes in the liability structure, liquidity resilience remains one of the key strengths of the merged institution. Overall, CAMEL composition, bringing all 5 dimensions together, gives us the overall CAMEL assessment. The study arrives at a composite rating of 1.4%, interpreting an excellent financial health. Capital adequacy is rated stronger, supported by approximately 21.6% CAR. Asset quality shows moderately weakened with GNP around 1.2%. Management efficiency is assessed as improving, particularly because of expected reduction in the cost to income ratio. Earnings are considered stable over long term despite short term phase pressure, and liquidity is assessed satisfactory with the LCR of approximately 115%. This shows overall conclusion as important factor improving across every financial indicator. Instead, it also created a financially strong institution experiencing a period of transaction, integration, and potential strong synergy realization. The key findings. 4 major key findings emerge from the study. First, robust capitalization. The approximately 21.6% projected CAR indicates a strong capital position. Second, manageable asset quality blending. The movement in GNPA is relatively limited and does not fundamentally undermine financially stable. The third, significant synergy potential. It says about the expected improvement in cost to income ratio towards is approximately 35%, and cross-selling opportunities could become major source of value creation. Last but not the least, liquidity resilience, which is the 4th finding of the study. An LCR of approximately 115% provides a substantial liquidity effect in transnational fundamentals rather than simply a financial consolidation. The next slide states about strategic implementation. From a strategic management perspective, the merger creates 4 important opportunities. The first, mortgage leadership. It combines of housing financial expertise with banking fundings capabilities, which can strengthen the HDFC banking position in the mortgage market. The second, cross-selling. The combination of customers base creates opportunity to offer banking, investment, insurance, and other financial products. The third, scale and underwriting capability. A large balance sheet provides greater capacity for large ticket financing and expansion into areas such as infrastructure and affordable housing. However, there is also an important risk. The last is integration and execution risk, which cannot be ignored. The longer term success of the merger depends on the technological integration, organizational alignment, maintaining asset quality, and effectively realizing the project cost and revenue synergies. Hence, the merger provides significant opportunity, but execution remains the critical successful factor. The next slide shows the conclusion. So, to conclude with, the HDFC Bank merger represents a significant milestone in the India's financial sector. The analysis indicates that the combined institution has a stronger capital adequacy, resilient liquidity, and substantial long-term synergy potential. At the same time, the study identifies short-term pressure on indicators such as NIM, CSA, and ROE, largely in the context of integration and portfolio blending. The overall CAMEL composition rating is of 1.4, which indicates excellent financial health. However, the most important conclusion is that the size does not guarantee merger success. Long-term value creates will depend on the ability to convert into measurable improvement in efficiency, profitability, asset quality, and sustainability credit growth. Therefore, HDFC merger can be viewed as ability to convert scale into measurable and improvements in efficiency, profitability, quality asset, and sustainability credit growth. With this, I would conclude my presentation. The study demonstrates that CAMEL provides a useful framework for evaluating the financial consequences of large-scale banking consolidating, particularly when short-term integration affects the long-term strategic synergies, which need to be considered together. Thank you for patiently listening. I look forward for any queries regarding to the paper. Thank you.